The world's largest mining convention has touched down in Toronto once again. We're at PDAC 2013. It's our first interview, and joining me today is Adrian Day of Adrian Day Asset Management. Adrian, thanks for being with me.
Well, thank you very much.
Welcome to Toronto. Welcome to PDAC. How's it been for you this past hour?
Past few hours. Well, it's certainly a busy conference. There's no question about that. It'll be interesting to see what some of these companies have to say. The thing I'm concerned with a lot of the companies is, how much cash they have left, because it's very difficult to raise money in this market, as you know.
We'll get to that point in a second. Adrian, gold down 17% from its high. Are you concerned right now?
Well, I obviously don't like to see it, but first of all, I like to put it in context. 17% is a lot, but since 2006, we've had two other declines. Well, we've had three declines, one more or less equal to this, and the other one, 22% and 29%. So we've had declines that are far worse than this in the last 5-6 years. I think we'll come through it again. I mean, corrections are part of a bull market. What's different about this, of course, is that it's gone on so long. Much longer than the other declines that I mentioned. But let's remember, after each of those previous declines, gold went up significantly afterwards, and the gold stocks actually doubled after each of the declines.
So what do you think is weighing on gold's decline right now, Adrian?
I think there's several things, but I think there's a sense that perhaps the bull market is over because quantitative easing is over and Europe solved its problems, and there's a sense that perhaps all of the factors that were bullish for gold are at an end or will be coming to an end. And so what we've seen particularly since September of last year, we've seen this sort of cascade of bad news. The U.S. economy getting better, the global stock market's going better. So a sense, hey, if the markets are doing well, do I really need to own gold? The economy's doing well, do I really need to own gold? Then you had the fiscal cliff with concerns of a recession, and suddenly the market says, oh, recession, that's bad for gold. I think what happens is the sentiment has changed. And when sentiment changes, then everything is put in a bearish context. So if the economy is doing well, that's bearish. The economy might do badly, that's bearish. But I think the key is that all of the factors that really drove gold are still intact. I mean, we talked about Europe just before. We talked about the sense that the Eurozone was getting its act together. But now look at the Italian elections.
Right.
That's changed.
Right.
And, the concern that some members of the Federal Reserve want to end quantitative easing or want to end bond buying sometime this year. It's been very, very clear, both from their actions and from what Bernanke has said, they're not going to end anytime soon.
But you know what's interesting, Adrian? We look at Indian demand. It's at one of its highest ever, Indian gold buying demand. We look at central bank buying, again, at some of the highest records. We might go into another record year in 2013 in terms of how much gold they're buying. Yet that's not really helping gold. So how much of a factor is that Western investors perhaps are just expecting a recovery in the U.S.?
I think is a very big factor, and of course that's what's led to the ETF, the selling of the ETF. If you look at the 10 largest hedge funds in the United States, they all, except for Paulson, they all either sold their gold or significantly reduced their gold at the end of the last quarter or beginning of this year. So and so the U.S. demand seems to come through ETFs more than direct physical buying. But that's been significant. And of course these things are all at the margin. So when you see a lot of selling of gold funds at the end of a year in a space of 6 weeks or 4 weeks, that has a significant impact on gold. I think it's important. But the thing to remember about the hedge funds is they tend to be momentum players. And I don't mean this in a disparaging way, but they're very quick at chasing the latest trend that's moving. They don't want to hold gold because it's good value and because they need gold in their portfolios as a diversifier or a hedge or anything else. They want to jump on what's moving. Gold's moving down, stocks are going up, let's sell our gold by the stocks. You and I both know that can change. It can change just as quickly as it changed the first time.
And the other flip side to that equation is because someone is exiting an ETF doesn't mean they might not be buying physical gold on the side.
Well, that could be. There's been suggestions that that's happening.
Right.
But there's no question there's been a big decline in ETF holdings,
So overall, you've echoed the same views as John Duty, the gold stock analyst, who believes that this correction, yes, it lasted long, but it could be coming to an end and gold could definitely be going higher.
Yeah, absolutely. I agree with that completely. Yeah.
So Adrian, let's get your thoughts now on the mining stocks. We're at a mining conference.
Yeah.
What's the sentiment you're feeling?
Sentiment is actually rather negative. My sentiment, or generally, the sentiment generally is very negative. And it's negative partly because it reflects what's been happening. The stocks have been absolute disasters for the last year or two, seniors and juniors alike. And when the gold stocks are disasters, it's not like IBM. They don't go down 10 or 15%. They go down 20, 30, 40%. And for juniors, they go down 70, 80%. So the sentiment's very negative. I think there's a couple of particulars that make people negative. One is among the seniors, we've had just horrible capital allocation. We've had, overpaying for acquisitions that don't make sense. And we've had huge capital overruns, building mines that don't really make money. There was this sense that just getting bigger, getting more ounces seemed to be the goal, not making money. That's beginning to change, but that certainly weighed on the sentiment. And among juniors, many of them are running out of money, as you know. I'm not going to name names, but there's a lot of companies that have 3, 4, 5 months worth of cash left in the bank. It's going to be very difficult for all those companies to raise money in the next few months.
Adrian, do you think we'll see a lot less juniors on the scene?
I think so, and frankly, I hope so, because there's too many, frankly. There's too many companies that don't have any asset, don't have any real asset.
And just going back to the stocks, since they're so beaten up right now, do you see that as a buying opportunity?
I do, but yes, absolutely. I think it's a great buying opportunity, but I think also one has to be extremely selective.
So what do you look for, Adrian? How do you pick them?
I look for great management. I'm not a geologist, so the property, people might notice I don't mention the properties as being the number one. I look for great management, and I look for good balance sheets. Because if you have good people and a good balance sheet, they'll probably do well.
But Adrian, what makes a good manager? What's a good CEO for you?
A good CEO is someone who doesn't overspend his money, who makes sure that it's just a good manager in all sorts of businesses. A manager who doesn't pursue false dreams and hopes, doesn't overpay for acquisitions, takes his time, buys when things are right. And there's a lot of those people out there.
Okay. Good thoughts from you today, Adrian. Thank you so much, and good luck on your presentation.
Oh, well, thank you very much.
And thanks for watching the start of our coverage here at PDAC 2013 in Toronto. We'll have lots more on Kitco.com. In the meantime, you can email me any comments or questions at newsfeedback@kitco.com. Thanks for watching.